One of the great stories of our time is, of course, the build-out of AI compute. And the company that stands at the center of that new build-out is SpaceX AI. SpaceX just went public with big attention globally, the biggest IPO in history with $2.5 trillion roughly market cap. And a lot of people, including me, thought it's slightly overvalued for the launch at the beginning of the launch of this whole build-out and the compute build-out. But we also saw that SpaceX has already some very big contracts, Anthropic and Google. And I want today to take some time to dig into the numbers to see what's actually going on and how we can make sense of this valuation. More importantly, to predict what is going to happen to SpaceX stock and put it into context with Palantir and Tesla, two publicly traded companies that are in the same space, in the AI space, and see where we land and what the actual EBIT and operating income potential of SpaceX is in the short term, not with Mars, not with AI satellites even, but with the most underappreciated opportunity of SpaceX. And actually Adam Jonas of Morgan Stanley, who does a great job in doing analysis on some of the key stocks like Tesla and SpaceX, has come out and said the following. So I shared this today. Adam Jonas said, "We believe SpaceX costs and speed in terrestrial compute is one of the most underappreciated aspects of the company." And I totally agree with Adam. I think Adam is spot on here, and we are going to look into the details. Terrestrial compute, of course, means to just build out data centers and lease them out before space is ready. Adam says we also believe SpaceX is on a path to vertically integrate the bulk of value-added parts in the data center to sustain industry-leading cost and speed per watt. Of course, what he means with that is that SpaceX can build out these data centers comprehensively, vertically integrated. And then he goes into all kinds of details that are not that important. But he says today, the company's vertical integration spans liquid cooling systems, battery installations, substations, and more, with public intentions to vertically integrate further across single crystal cast turbines, solar manufacturing, networking, and eventually the compute itself with terafab to eliminate potential bottlenecks to AI compute scale. What Adam says here is that Tesla has a very unique ability. Not Tesla, SpaceX, sorry. Tesla team, SpaceX, all the same at this point. SpaceX has a unique ability to build out data centers because they can also build out energy by Tesla Megapack additions, but also by installing turbines, gas turbines, and grid connectivity, substations, all of the things that normal data center people cannot do. They have proven that they can do it with Colossus 1 and now also Colossus 2. Now is the time for us to look into a model. It's very rough, but it's a back of the napkin, back of the Google Sheet model that tells us actually a lot of what's going on. I would just want to share it quickly today to show where we are at. It actually shows you tremendously interesting things. Let's set the stage here. I split it into H1, the first half of 2026, to the last half of 2027, 4 6-month periods. Why? Because this is actually very easy to understand. This is basically today. Today, it's the past from January to June of 2026. So we can look at what we actually have here. And then we look into what happens in the next half from now to December, what happens in January to June next year, and what happens very likely from July next year to December. We have 3 big assets. We have Colossus 1 in Memphis. We have Colossus 2 in Mississippi and Colossus 3, which sits right next to 2 on the same lot, kind of. These are the 3 data centers we are looking at. And when we look at the capacity, Colossus 1 in gigawatts has installed roughly 0.3 gigawatts, 300 megawatts of energy. This is all about the energy installed that will then be applied to the GPU clusters. And these GPU clusters, as I will explain in a second, will have a compute multiplier based on their composition. How much Hoppers, H100s, the old GPUs, how many B200s, to make it simple, the Blackwell type GPUs, and then how many Vera Rubins, of course 0 right now, but the next generation NVIDIA chips that will come probably end of the year. to start being installed and then fade out Blackwell over time in 2027. And I made it very simple for you. We have a more high resolution model that I won't present here. It doesn't matter. The way to look at this is that we have a total gigawatt install base of energy. So the energy, how much gigawatts do you actually have in these things? And then we look at compute. So total, currently 1.2 gigawatts. We have 1.4 gigawatts projected in the second half of 2026. I'm a little conservative here. Maybe Elon sees this and laughs and says it's going to be 2. Whatever, we are going to be a little reasonably conservative because we don't know exactly. But we know it's aiming at 2 at the end of 2027, latest. This could be shifting to the left, but let's say it's that. So here you have the energy multiplier. I will explain in a second why we need these multipliers, because then we can apply it to the current revenue they're making from these three in H1 2026, the Google and Anthropic revenue. By using these multipliers, we can do very simple math. How much compute they probably can rent out. It's simplified because they're not renting out all compute, but if all the ratios stay the same and there's just scaling it, the ratio of how much they use, how much they rent out, we are getting to very good numbers, to very reasonable numbers. Energy multiplier therefore is 1.0. That means in the next half of this year, or this half of the year, they will have 1.2 times the energy available. In H1 2027, they will have 1.3 times the energy available, and then they will have 1.7 times the energy available. Now here comes the compute multiplier. We have then to multiply the energy available times the compute multiplier. The compute multiplier, as I explained, means how much more tokens, how much more compute per gigawatt can I get out? Okay? Together, energy multiplier and compute multiplier lead to a revenue multiplier. And that is the number, then I stop boring you, because that is the only number you need to understand from an investment perspective. That revenue multiplier tells you how much more money can they make. And this is all middle of the road assumptions. So the compute multiplier is 1, then 1.5, assuming more Blackwells, only Blackwells installed from here on out, only more Blackwells installed from here on out for 2027, H1, and then Vera Rubin coming in, pushing that multiplier even higher. Of course, this is a blend. Vera Rubin should have roughly 5 times multiplier over Hopper, effective multiplier per kilowatt. But here it's a blend. So together that leads you to the revenue multiplier. That is how much more money they can make and add to the current revenue. Okay, gross margin doesn't matter. This is roughly what it is. And then we have here the actual operating expenditure and depreciation things, like how much do you have to subtract from that gross margin to get to the EBIT, the actual operating income of the company. That currently the run rate including the Anthropic deal and the Google deal, roughly 26 billion, is roughly $12 billion EBIT. Okay, that is what counts here. Now comes the interesting thing. If this build out progresses, and I just have a great conversation with CERN, Basher, the famous CERN bird, about this whole situation. And he was just there visiting Colossus 2 and 3 and saw all kinds of people doing things on a Saturday, which means the build out is actually happening. And that means as early as this half of the year, the second half of 2026, we could be looking at $20 billion in EBIT, in real EBIT for SpaceX. Run rate, of course, so annualized. 20 billion, up from 12 billion. That's a huge leap. And next year we could look at 31 billion, and end of next year we could have a run rate of 50 billion. Now, Brian, for example, of Next Big Future has much higher numbers, but I think this is actually pretty sophisticated what we did here and pretty reasonable assumptions. Now we can beat that maybe, but this is a middle of the road assumption. That would mean SpaceX would nearly 5-fold, let's say 4.5-fold, 4.5-fold, 350% added profit growth in the next year. That will surprise a lot of people, because if that is true, we are not waiting for Starship. We are not waiting for AI satellites. We are not waiting for all the things that might not happen or might get delayed. I think they will happen, but probably not next year. Hey, on this channel, we do something very important. We deeply analyze, understand, and predict capital, AGI, and politics. Not just to beat the markets and make a lot of money, even though that's important, but also to build a new society and make the future good for all of us, the pioneers. If you want to help me on this journey, you can do that by doing a very simple thing: like and subscribe. It helps me a lot. Thank you so much for your support, and let's get back to the video. And that means we have massive, absolutely massive growth. To give you a sense, and I talked about this on Sunday, this is the equivalent of 100,000 Tesla robotaxis in operation to get to 50 billion. So here is a very middle of the road, pretty non-aggressive assumption based on tons of evidence on the ground that this is actually happening. How we get to the equivalent of 100,000 deployed robotaxis, run rate by end of next year for SpaceX, $50 billion. Okay, think about that. So we are basically adding 8.9 billion this in the next 6 months, 8.9 billion hard cash profit to SpaceX run rate, not absolute profit. We are then adding another 10 billion. And then we are adding another 17 billion. That's a lot of adding. And here's the 6 months growth rate. So how much does it grow 6 months over 6 months? And here's the absolute growth rate, right? Or the absolute growth multiple. So SpaceX will be a 1.8 times larger company already this half of the year. It will then be a 2.7 times larger company in the first half of 2027 and a 4.2x larger company end of next year. Okay, now it gets very interesting. Let's get to the share price, what that means. And this is a very rough back of the napkin thing, but I wanted to share it with you so you see what could actually happen here. And this is extremely reasonable, by the way. The forward price earnings ratio of SpaceX, based on a $150 share price, $2 trillion valuation, which is pretty much what it is right now. It would mean that right now, based on the run rate, we are at 170 times forward in the sense of run rate, price earnings ratio. That is like not bad, not good, not great. But don't forget, Tesla is at 200 times. So it's already cheaper than Tesla right now, which is kind of interesting. SpaceX is already cheaper than Tesla right now. Of course, if you're a Tesla investor, you would say, well, this is about to change in a big way, but it's also about to change in a big way for SpaceX. Isn't that interesting? Already this half, end of the year, so in 5 months or so, that would drop to roughly 100 forward price earnings, would then drop to 63 price earnings, and would then drop to 40 price earnings forward. That is extremely low for a company that grows insanely strongly with an insurmountable moat. But now we get to the most interesting part of the video. Let's do the bottom line here. What does it mean in terms of comparing it to Tesla and comparing it to Palantir? And just so you understand what I mean with that, we can go up here and see the assumptions. Tesla is currently a forward price earnings ratio of 200. Palantir price earnings ratio forward of 90. These are great comps, right? So if we apply these metrics, we can compare SpaceX to Tesla or to Palantir. And what you see, what happens here, if you do that, okay? If you would, here's how this works. If you would apply Tesla's forward price earnings ratio to SpaceX, you can derive the market cap that would be appropriate if you take for each of these 6 months periods the run rate of EBIT and would say if it would be valued like Tesla on forward earnings, what should be the fair market price that makes it equivalent to Tesla? And the answer, surprisingly, for SpaceX right now, or not even right now, last half is 179 because of these huge cash inflows. 2.3 trillion would be the fair market value if it would be valued like Tesla, not on revenue, because on revenue it should be valued at only $35, but on EBIT multiple forward, it should be valued at $179. So it would be basically undervalued right now at 150. But now look at that. If that stuff comes true, okay, if we get to $20 billion EBIT run rate, $20 billion EBIT run rate, if you would value it like Tesla earnings-wise, you would get the price end of this year to $314, which, by the way, is exactly the target of guess who? Adam Jonas. So it looks like I agree with Adam Jonas for once, because he said with a $300 price target and a bull case of $600 per share, $8 trillion market cap. Isn't that interesting? When I did this in comparison, like, interesting. End of this year, if valued like Tesla, I would get to the exact same price target as Adam Jonas. I find this very interesting. In June 2027, I would get to a price target if I compare to Tesla to 478. That's a lot, 6.2 trillion. And end of next year, if these things come true, which I think is more likely than not, by the way, we would be at $747 price target for SpaceX. Pretty aggressive. Always assuming it keeps as high of a price earnings ratio, forward price earnings ratio, as Tesla. And of course, Tesla only has such an insanely high price earnings ratio forward looking because people believe Tesla will have an earnings explosion. However, what we see here is SpaceX will very likely have an earnings explosion and will continue having one going forward. Maybe we will hit a little bit of a snag then. That's, I think, is more likely than not in 2028, because then there will be a little lag year before space can catch up, while the policy resistance to terrestrial build-out will increase. So here we might have a growth problem. So 747 is maybe a little bit high because people would then bring down that ratio. So let's look at the Palantir comp to see how it will compare with a little bit less extreme stock like Palantir, even though some consider it also extreme. At 90 forward price earnings, if you do that, the share price for SpaceX would be valued at 81 right now, which is what people, that's actually more in line what I would have said, that SpaceX is too high right now because they haven't shown all that stuff. But if they would show that, and I think they will, the fair share price would be 141, nearly where it is right now, end of this year, which is very interesting. Because, I think there's a lot of selling pressure coming in. Tesla is a little bit out there. So I think Palantir is a more reasonable comparison. And that means by end of this year, December, the share price could be where it actually is right now and would be pretty fairly valued. I think the reality is it's more likely to be between this and 314, but let's see. But then in June of next year, if you apply just a Palantir forward PE, you would already be at 215. And then end of next year, you would be at 336. Again, close to the Adam Jonas price point, but 1 year delayed. What does it all tell us? It tells us that while I think without all that stuff, SpaceX is just ridiculously overvalued right now, this stuff is actually happening. We see action on the ground. We know Colossus 2 is being built out like crazy. We know Colossus 3 is already built, the building. We know the permits are mostly there. So yeah, there is a lawsuit, there's some resistance. It's also a very red state. Trump is for it. Unlikely that this just gets held up. Maybe it gets delayed 6 months, maybe not. But the interesting thing is that SpaceX has massive, massive, massive earnings coming in, and there is not much we can do to hold it up. And that could end up in a very reasonable scenario. Oh, I didn't even share the model. Sorry about that. In a very reasonable scenario, could lead to actually this whole situation that we have $50 billion here in actual revenue in 2027 run rate end of the year. And if this all happens, that would be pretty crazy. It's actually not crazy. It's very likely to happen. So there you have it. That is what I think is going to happen. And that means SpaceX is actually relatively cheap. And given the fact that I'm pretty sure it's going to fall more when all these shares unlock in August to November, it's probably time when SpaceX drops below IPO and we see these things happening to buy some SpaceX, or not just some, but a lot. I hope that this was interesting, and see you tomorrow.